So, welcome to our last 3CL seminar in Michaelmas term. My name is Felix Stefek. I'm directing 3CL, and it's a great pleasure welcoming you to this last 3CL seminar. It's of course only the last seminar for Michaelmas term. There will be further seminars in Lent. And we've got a particular and a special guest for this last seminar. Martin Voitko visits us from the World Bank. And Martin, I hope I'm not saying anything confidential when I say that you have been here before as a student a long time ago. And it's great to see you back. In fact, you have been here a student before I arrived at the faculty, so that was a time that I don't even know of. We are very much looking forward to your seminar. You'll speak on structured finance. You'll give us a primer. And I think that's a great topic for actually fitting very well with multiple courses, in particular the MCL various modules, but also the corporate finance law course. And I think a particular great thing is today, you're willing after also to explain, answer questions. So as always, we'll have first a presentation of around 25 minutes, 30 minutes, and then Martin will be around for questions and comments. So Martin, thank you very much for making your way here. Welcome back home to your academic home, and we're very much looking forward to your seminar. Thank you, Martin.
Well, thank you very much, Felix, for such a lovely introduction. It feels good to be back. I've been told that you might have some interest in structured finance. So I do have a sort of a rough idea what is I want to be talking to you about today. So I produced sort of a slide deck with a few things I'd like to touch base on today, but nothing is carved in stone, so we might readjust as we go on. If there is something which you find relevant or sort of interesting, we might actually dive deeper in that. And as well, if there is something which is not so interesting, we might simply sort of skip. All right, so that being said, I think we have a lot of ground to cover today, so why don't we get started? It's actually my favorite slide, because it really touches on the two most important questions. And one is, why do we like it? Well, first of all, there's lots of money involved when it comes to structured finance. How much, nobody knows. And the reason is that structured finance to different people means different things. So at the core of structured finance, you do have securitization. So structured finance always does equal securitization. So that's going to be the core I'd like to talk to you about today. And we're going to be talking about sort of both the traditional securitizations as well as the synthetic securitizations. But also, when we talk about structured finance, you do have different products. So you would primarily see covered bonds. You might as well see repacks or some sort of more exotic type of structured products, such as diversified payment rights, which are effectively remittances of future cash flows. But these things we skip today because we only have roughly 25 to 30 minutes. And the way I want to sort of present that to you is I've been doing structured finance for nearly a decade with the European Investment Bank. So instead of going into some sort of a legal language and literature that you can read about, I think that we're just going to focus today on the practical angle. And I really want to tell you what is the difference between securitization, covered bonds, and different structured products. I want to tell you what is the difference between traditional securitizations versus the synthetic securitizations. So, and hopefully also to share with you, some of the experiences that I had over the 10 years, which sort of will help you to have that sort of, hopefully an intelligent conversation whenever you might be interviewing with a law firm or whatever it is you want to do next with your career. All right. So I think, if there is one slide that you would remember today, please let it be this one. And as I said, primarily I want to be talking about A and B, which are the securitizations. And if there's enough time at the end, we might also be talking about covered bonds. Now, traditional securitizations, in the industry, you call the traditional securitization sort of like cash securitizations. And the only reason why you call them cash securitization is the sole reason of raising cash. So effectively, what you're doing when you have a traditional securitization, you are taking a pool of illiquid assets. Usually, those are always loans or leases. You're bundling them, you're packaging them, and once they're bundled, you're selling them off to investors. When you sell them off to investors, you're getting them off your balance sheet in exchange of getting sort of a money coming in from the investors. So that's the core of traditional securitization. Traditional securitization, it goes by different names. You know, they call the ABS, the asset-backed securities. You might have sort of different asset classes in there. You probably heard of the CDOs, collateralized debt obligations, or CLOs, collateralized loan obligations, RMBSs, residential mortgage-backed securities, CMBSs, commercial mortgage-backed securities. You might have credit cards. You name it. There are different asset classes, but always, it is about raising cash. Nothing else but raising cash. Now, in contrast to that, synthetic securitizations are called sometimes the capital relief trades. And the only reason why you do a synthetic securitization is to get a capital relief. Now, there is a place in Switzerland called the Bank of International Settlements. It is a very small organization down there, and you know they're very smart people. What they do, it is effectively a central bank of central banks, right? So every jurisdiction has a central bank. Now, across the world, you do have a central bank of central banks, which is the Bank of International Settlements. Now, they design a sort of a global banking rules. Now, those banking rules, I don't know if you heard about Basel Accords. So you do have a Basel I, Basel II. Currently, we have Basel III. In EU, as well as to a large extent even in the UK, that's been sort of transposed through CRD4 package, which is the Capital Requirements Regulation and Capital Requirements Directive. Now, under those rules, you do have rules on liquidity, on capital, and so forth, but the basic principle of that is that the bank is supposed to hold certain capital for the rainy days, right? Because effectively, if you think of it, banks are wonderfully leveraged institutions. All they do, they take in loans, or they take savings, and they'll actually lend out. The biggest problem with the banks is they also prone to bank runs, and they do go under. I mean, you all are too young to probably remember Lehman and Bear Stearns in 2008, but you are all young to at least remember that the fall of Silicon Valley Bank earlier this year, and sort of the collapse of regional banks, the First Republic in US. So banks, they really do go under. Now, with a synthetic securitization, the sole purpose of that is to release some of the capital that the bank is required by the regulation to hold back. What it effectively means that for every asset that the bank has, by regulation, it is required to be holding certain assets. That's your regulatory capital. Now, once you hit that barrier on the regulatory capital, that the bank has very few options how to deal with it. It can sort of raise additional capital, but the capital is expensive. It can raise different instruments. You've probably heard of additional Tier 1 instruments. There was a sort of a big outcry earlier, again, in the year with Credit Suisse, when sort of that additional Tier 1 was not even converted, but simply the investors in AT1 were evaporated. And one of those, one of the options that the bank has is also to do sort of a synthetic securitization. So the only reason why you then have the synthetic securitization is to do sort of a capital relief on part of the balance sheet of the bank. So huge difference here. A traditional cash securitization is going to be influenced and heavily drawn by market standard. Whereas with synthetic securitization, the entire transaction is going to be driven by bank regulation. So the banking regulation is going to be setting you the limits on what is it that you can do, as well as it is going to be setting you the standard for the documentation. And then very last is the covered bonds. Covered bonds, the basic characteristics of covered bonds, for you to remember, is that you have something which is called a dual recourse, which means that if you're an investor in a covered bond, you have a recourse against the bank as the issuer, but you also have a sort of a second recourse, and that is against the ring-fenced assets that form part of the collateral. So that's why the covered bonds are supposed to be super safe. They evolved from the German Pfandbrief, and they've been around for 200 years. And hopefully that will make you to remember why they're super safe. In 200 years, there has not been a single default on that asset class, just because of this sort of a dual recourse nature. So they're super safe. The only drawback, again, if you're an investor, if you're holding something that safe, is that it probably is not yielding as much as might be the traditional or synthetic securitization, which are riskier, right? Yeah, because it's a function. If you have a riskier asset class, then it's probably yielding you more than something which is safe. All right, so that's a very short introduction into what sort of different type of structured finance or sort of structured products we're going to be talking about today. And let's get to securitizations. This slide will apply to both cash as well as the synthetic securitizations. And effectively, for a securitizations, you're always going to need exposures and something which is called tranching. Now, exposures, they go by different names, by industry standards, never get intimidated. Some people, they call it underlyings, ref-ops, as for reference obligations. But effectively, the exposures are always loans or leases. Why? Because you need something that has sort of an identifiable income stream. When you're modeling that risk, you need something that you know how much is owed, when it's going to be repaid, what is the amortization, what is the repayment profile, and so on. What securitization does is you have those loans, exposures, represented by these dots, which are itself illiquid, right? Because nobody wants to be buying some sort of a loan that I might have as a mortgage. Because you have no idea what is my credit worthiness. None of that has been analyzed by you. So effectively what an issuer on the ABS securitization does is it pulls a lot of illiquid assets and it bundles them in a single package. Now, you might have thousands of loans in here. You might have dozens, or you might only have one loan, right? I mean, the one with the loan, that is sort of more unusual, but it's okay. It doesn't matter how many you have in here. Generally, you would have, if you have a granular portfolio, you would have thousands of individual loans or exposures. If you have a less granular portfolio, you usually run at least 2 to 3 dozen. Now, what you do then is, so you put all those reference obligations into one pool. But for you to have a securitization, there must be an element which is called tranching. Without tranching, you would never under any circumstances, you would have a securitization. It doesn't matter if you would have all the characteristics of the cash securitization or synthetic. This is an absolute must. Effectively, what the tranching does is it separates the risk profile of various tranches in that pool of assets. And what do I mean by that is that the tranche here will be riskier than the tranche here, right? Because the tranche here is providing something which you call the credit enhancement or credit support, to the holders of the tranche here. So usually you would have a junior tranche and a senior tranche. Without this you would never have a securitization. Now, the holders of the securities in the junior tranche are going to have a riskier position than the holders of securities in the senior tranche. But effectively what it means is, when I started, and then I was looking at tranchings, I always thought like, the holders of the junior tranche, that these are the loans which are kind of shadier, or which might have a sort of a lesser credit quality than the ones here. And I felt like, up here you would only get the loans which are of good quality, where you have a good borrowers that have a good credit rating and so on. Well, none of it is true. Because it doesn't really matter where you have the loans. You might have a really good loan here, but you might have a really good loan down here. Because the tranching is not related to the individual assets that you have in the portfolio. What tranching does is just determining how you allocate losses to your portfolio. What does that mean? It means that if you're going to suffer, if you're going to take a hit on a loan that's here, so the underlying obligor is going to default on this loan. And you're going to take another one here, and you're going to take another one here, and so on. But it means that all these losses are going to be added up and added first at something which you call the attachment point as your junior tranche. What effectively that means that if there are any losses on the portfolio, those losses are always going to be borne by someone starting from the very bottom. So there's always going to be a bottom-up principle, meaning that anyone holding junior tranche gets the first hit. And as you move on, as there are more and more hits, you move on, and potentially, if the portfolio is performing really, really bad, and it's defaulting, then even the holders of the senior tranche might be affected. But it means that if the holders of the senior tranche are affected, it means that the entire junior tranche has been wiped out. Right? Now, usually you would see in securitizations not only a junior tranche and a senior tranche, but you would see some sort of a middle tranche, which you call sort of a mezzanine tranche. And the only reason why you do have a mezzanine tranche in the portfolio is kind of to optimize the costs of the structure. Right? Because the junior tranche, because it's riskier and it's not actually the first tranche to take the hits on the portfolio, it is paying a higher interest than a safer tranche, which is a senior tranche. Which then means that the reason why you usually would see a mezzanine tranche is kind of to optimize the costs and benefits between the various holders of different ABS notes. But this is the most basic principle of securitizations. So always you take an individual assets, you bundling them together into a portfolio, and that portfolio has to be tranched. Without tranching, you would never, ever have securitization. Allocation of losses, always bottom up. Always. No exceptions. The amortization of loans, because remember, all the loans are amortizing, right? I mean, we talked about loans and leases. So with the time, you are repaying the loans, or you're repaying your lease, right? When you're repaying it, it is amortizing your portfolio. Now the repayment is usually following the opposite approach, so it's going from top to bottom, meaning that holders of the senior tranche, they get repaid first. And only when they repaid, you actually come all the way down to the junior. And the reason is that if you're a junior tranche holder, you're expected to be taking the risk on the junior tranche, right? So if you would be repaid prior to the senior tranche, then effectively you would be losing that credit enhancement. The amortization can be, this is the usual standard, but the amortizations can be different. It can be even pro rata, meaning that you would be, on this structure, you would usually have a senior tranche amortizing with a mezzanine. It would be quite rare that you would have a sort of a full pro rata with the senior, mezz, and junior. But just for you to, this is a one-on-one course, but for you to understand, loss is always bottom up, amortization top down. And in here, again, these are your attachment points. And once you exhaust the entire tranche, it's your detachment. So that's very, very briefly on how a cash or a sort of synthetic securitization works. Now, on the traditional securitization, and again, it's a very simple slide, but for you to understand what's happening, I think this is a core of it here. So effectively, as we said, you have someone that's called the originator. That's usually that's going to be your bank, usually. Now that bank would have a lot of loans or leases, right? These are your underlyings. So it's originating loans to the borrowers, and the borrowers logically are paying interest, and at the end they're paying the principal of that loan. Now, what the bank does, it takes a lot of those loans, bundles it together into a portfolio, and sells those assets to an SPV, right? So that's your special purpose vehicle, or securitization special purpose entity, which then issues securities to the investors. Now, investors, when you say you issue securities, what you mean is that investors are buying that portfolio of assets. They subscribe to the securities, and that's where the word securitization comes from. Effectively, you're taking liquid assets, you're transforming them into securities. So that's how you get sort of the entire concept of securitization. Now, you subscribe to securities, meaning that you actually fund the cash back to SPV, and the SPV is actually on transferring that cash back to the originator. So effectively, the originator has sold off the assets of its balance sheet in exchange for raising of the cash. So that's the reason of having a sort of a traditional securitization. Now, the only reason why you have this complication here is the bankruptcy remoteness of the SPV. Because what you want to achieve is you don't want the bank or the originator to be issuing directly the securities to the investors. Because as we talked about it, a bank can go under, they do go under. We saw it in 2008, we saw it earlier this year. Credit Suisse almost went under, so banks, they do go under. But also other issuers, they do go under. So the only reason why you're then transferring to the SPV is that the SPV is not doing any other business, it has no employees, it's effectively a sort of an empty shell, right? So it's just holding that portfolio which it purchased. That portfolio is bankruptcy remote. And unless you have defaults on those individual loans, you have isolated yourself of the risk of someone, of a bank going under. And obviously, because it's an SPV, you're going to need a lot of the ancillary service providers to actually to help you run the entire infrastructure. So that's in a nutshell what the cash securitization looks like. And this is sort of a more complicated diagram, but again, don't be intimidated by it. It's exactly the same things that are happening on this diagram. So you have your seller, that's typically your bank, that it has lended. And so this is actually an example I've done. This is a lease securitization. It's exactly the same you have a bank securitization. So it does have the borrowers or obligors, so there are lease or loan agreements, and it's taking collection, right? So that's coming back to the bank. What it has done, it has sold it to the SPV, and the SPV has issued securities to to the security trustee. And then, ultimately they've been issued to the investors. Now, the bank then gets back the money from the SPV, but also there's a slight complication is that once you sell those assets in a cash securitizations, you need somebody to continue to service them, which means that it's usually the bank that sort of it takes on the role of the servicer. So you still have a sort of a relationship or sort of a lender of record with the original bank. That means that if you're a obligor or if you're a debtor, you still continue to pay that loan back to the bank, and the bank has then the obligation to be transferring the money back to the issuer, who is then distributing those profits to investors. And of course, up here, that's just your infrastructure, making sure that that this is an SPV, so the SPV has no director, so you need somebody to provide sort of the corporate services. You need somebody to be dealing with the data protection issues and so on. So that'd be sort of a typical structure of a cash securitization. And the only reason why this looks so complicated is that you're really trying to achieve a bankruptcy remoteness of an entity that's issuing the ABS notes. That's the only reason behind that complication here. And probably the most critical aspect of any cash securitization is exactly the element of transferring the assets from the bank to the SPV. So that's something which you call the true sale. And for true sale, the law firm is usually required to issue a true sale opinion, and that's probably the most critical part of doing any cash securitization. All right, synthetic securitizations. Now, synthetic securitizations are very, very different. I mean, they can be very, very easy. Effectively, the only reason why they're different is not only you're doing a sort of a capital relief trade, but because you don't have the true sale, right? And because you don't have the true sale, you don't need that complication as we just shown here. Synthetics, then they documented in two forms. One is a financial guarantee. The other one is a sort of an issuance of credit-linked notes, CLNs. Right. So you ABSs, so asset-backed securities, ABS notes. That's always for your cash securitization. CLNs are for your synthetic securitizations. Now, what is happening here? Again, it's a very simple relationship between the originator. You're going to have a bank, and you're going to have a counterparty, so somebody taking on that risk. You document it through the financial guarantee, and you're taking the risk on the reference portfolio. Right? And we talked about it, and this is exactly the same as we talked about for cash or synthetic securitization. So the bank is packaging loans, putting them in a portfolio, tranching the portfolio, and selling off the risk on the portfolio to someone else. Now, the difference between synthetic and the cash is that with cash, the bank is actually selling you the assets. Here, the bank is not selling you the assets, the bank is keeping those assets. What the bank is doing is just selling you the risk on the assets. So think of it almost like an insurance. It's not an insurance, it's very different than insurance. But if you're a bank, here effectively you're just buying an insurance from a counterparty. If any of those assets, so if any of those loans go under, somebody's going to make you whole for those assets. And you as a bank, in exchange, you can release that regulatory capital that she would otherwise be required to hold against those assets. Right? Again, the portfolio has to be sort of tranched between senior and mezzanine or junior, but at least there has to be an element of tranching. So there must be a contractual subordination. Here's another example of synthetics, which is slightly more complicated, but it's So this is an example illustrating the CLN structure. So these are credit-linked notes. And here, what is happening is the originator is exactly doing the same thing. So the originator is selling the risk on the assets to the investors, but it's doing through an SPV. Now, you would have the trade protection document using the originator and SPV. That's usually through a credit default swap, but you might do it through a sort of a financial guarantee. The SPV would issue the notes, would issue a credit-linked notes to investors. It would have sort of a senior credit-linked notes, NES, and junior credit-linked note, which would effectively be funding the cost of protection of the SPV that it has vis-a-vis the originator. This is slightly more complex, but again, the principle is exactly the same as with the financial guarantee. Always remember that here, unlike with the cash securitizations, you're not selling off the assets. You as a bank are sort of holding those assets. All you are selling is the risk of default on these assets. So if you think of synthetic securitizations, the best proxy is really to think of almost buying like an insurance on the assets that you hold. But be very careful because it's not the insurance. There's a sort of a very lengthy regulatory analysis making sure that this is not a product of insurance. Because if you have an insurance in UK and elsewhere, you need to be licensed. It's a regulated business, so it's something very, very different. But economically, it is almost like an insurance. Providers of, again, with the cash securitizations, what should I also tell you is cash securitization originators are usually, they might be banks, but they might be different corporates. As long as you have sort of a stream of receivables, so as long as your business has some sort of a debt risk, you can issue ABS securities. And investors can be, you name it. With synthetic securitizations, because we talked about Basel rules, your issuers or the originators would be the bank, right? Because the banking regulation only applies to the banks. And then your counterparty, so somebody assuming that risk, usually you would have either hedge funds. Hedge funds would be coming on usually for the junior tranches because they're much more aggressive. But so the junior tranches are the riskiest, but they attract the most rewarded. And then for the mezzanine tranche, you would have multilateral development institutions such as EIB, EBRD. That sort of sits between. And for the senior tranche, either senior tranche would be retained by the bank because it's not so penalizing capital-wise. Or you would have sort of institutional investors, so pension funds and so on. Right. Any questions? Are we just